Hi, and welcome to Trading with TK, teaching you to turn ideas into money. We're at www.tradingwithtk.com, and today is Tuesday, December 2nd. Okay, got another good question tonight to answer. It's a topic that I almost completely forgot about until I got this question from one of my readers today. So we'll answer that. Then we'll talk about today's action in the market. And in our final segment, we're going to go over the indexes so that you firmly see the picture, how it's still intact. Today's action basically didn't change anything. But let's get to the question first, okay? This question comes in from a fellow by the name of Rhett. And Rhett writes, can you tell me how the absence of block trades have affected the volatility of the marketplace? Thank you, he says. You know, I forgot about block trades, okay? So, block trade is defined by 100,000 shares or more. It wasn't always 100,000 shares. There was a time when it was 10,000 shares was considered a block. But I'll get back to that. I'll take you through the history of it. But first, there's two kinds of block trades. The first kind of block trade is when two principal, a buyer and a seller, get together and one wants to buy the 100,000 shares and the other one wants to sell 100,000 shares, and there's no third party involved. For instance, the teacher's pension fund wants to buy 100,000 shares of XYZ, and the United Auto Workers pension fund wants to sell it, and a broker brings them together, and they basically trade. You know, one buys the 100, the other one sells the 100, and then they walk away, and there's no position left over. But I don't think that's the kind of block trading that Rhett's talking about. I think Rhett's talking about the gunslingers, the big boys of Wall Street, the gunslingers. And to explain it to you, I need to go back to the beginning when it first started down there. You know, every order we used to get was 100 or 500 shares. Then as time went by and more money came into the market, then we saw 1,000 share orders. And then they became commonplace. Then we saw 5,000 share orders. We thought they were big orders. And then as time went by and more money came into the marketplace, 5,000 share orders became commonplace. And now there were 10,000 share orders. And that's when they first deemed what a block trade was. It had to be 10,000 shares or more. Now, then 10,000 shares became commonplace, and next thing you know, we saw 20,000 share orders and 25,000 share orders, and then they became commonplace. We started seeing 50,000 share orders, and then 100,000 share orders, which is now what a block is. A block trade is 100,000 shares or more. Okay, so the market's expanded. You know, the size of the orders were just getting bigger and bigger and bigger. So, if one of these investment banking firms that usually did business with these big funds would come into the specialist, he wanted to buy 100,000 shares of XYZ, you know, we would offer to him probably up $0.75 of a dollar or up $1, unless, you know, especially if we had to sell, you know, more than half the stock. But this wasn't good enough for them. So the business got so competitive that they wanted, the investment banking firms wanted to capture these orders. They wanted to get the commission dollars. So in order to do that, they assumed the risk to the customer. In other words, they would come in and they would buy whatever they could, up $0.1 of a dollar from the specialist and from the book. And then maybe, let's say it's 20,000, 25,000 shares. Then they would sell the other 75,000 themselves. They would, you know, position the stock to their customer just to get the order from the customer. That's how competitive this business got. Now they're short 75,000 shares and they've got to buy it back. Well, trust me when I tell you, 99.9% of all these trades didn't work out for them. They always wound up losing money. But it was okay because all the trading desks, all the block trading desks, were earmarked to lose money. They were allocated X amount of dollars to lose every year. And well, you say, well, why? The reason is that the commission dollars was so high back then that these block houses could lose $10,000, $20,000 on these trades and still walk away making money because the commission dollars was so high. And that's how the block trading all got started. And it got pretty competitive, and it went on for quite a while until commission dollars became negotiated and the rates started dropping, and then the risk reward just, was a totally different story for these guys. They couldn't afford to lose money on the trade. They needed to make money. So therefore they weren't allowed to, they couldn't offer the guy the $100,000 up an eighth. If they wanted to make money, they'd have to offer him up where the specialist normally would have offered him. So the business kind of died because commission rates came down. So how did it affect the volatility? That's a good point. I'm not really sure. I'm going to say my guess is that it increases volatility because these customers are still out there doing business. They're still buying and selling their 100,000 and their 200,000 share orders, but now they're doing it through algorithms where they'll do 20,000 shares every hour and then walk away, then another 20,000 shares every hour and walk away until their order is finally done. So it's done in bits and pieces. It's not done in one big block. So I'm gonna have to say I can't document this, but my guess is that it has definitely increased the volatility of the market because that 100,000 shares is no longer contained into a small eighth of a dollar up an eighth. Now, if this guy wants to buy 20 or 30 grand, all the markets are electronic. They sweep the book until they're finished. They may have to pay up $1.50. So my guess, Rhett, is that it has definitely increased the volatility of the marketplace. So I hope that answers your question. It was a good question. I completely almost forgot about the big boys. So when you hear me talk about the big boys, that's who I'm referring to, the gunslingers, the big block traders. Okay, let's talk about the market now. I saw today's just a kickback, and we were up 200-something points at the end of the day, down 600 yesterday. We're still got this major downtrend that we're in, and until that changes, I cannot possibly turn any kind of bullish whatsoever. So we'll take a look at the indexes so you get these pictures clearly in your mind, and you'll see what kind of downtrend we're in. Like I said, today did not really change anything. So in just a moment, we'll go take a look at the major indexes. This is the daily bar chart of the Dow Jones. I'm going to run through these quickly. As I said earlier today, today's action really does not change this picture whatsoever. We're still in this big downtrend here, and trend is your friend. And until the picture changes from where it is right now, my outlook has to remain negative. And a quick look at the transportation average. Same view, same kind of downtrend, the same kind of day. The artists who drew this today's action, they look the same in all the indexes. Today's action looks exactly the same, but it doesn't change anything. A quick look at the Russell 2000. It confirms this downtrend we're in. So, I still remain negative until that downtrend changes. And then lastly, the QQQQs. Picture's worth 1,000 words. We're still in this downtrend. We just keep getting lower lows, lower lows, lower lows, and lower highs. And it clearly is a downtrend. So the odds favor the fact that probably a new low will probably be made somewhere down the road within the next few days, I would think. Anything is possible, but until things change from what I see here, the outlook remains negative. Okay, that's my view of the market. Till tomorrow, TK signing off.